Do you know what the stock market hates more than bad news? It is uncertainty. If you are subscribed to this channel, you know that even more so than bad news. If you have a lot of uncertainty in the markets, the stock market is going to refer to that as ultra bad news. And that's what happened today, and specifically why the market sold off so much. And if you even look at the last 1 minute candle on the S&P 500, that was 4.5 million for volume. This is a panic move, as well as you've seen the treasury bonds hitting crazy levels today, a 2% positive move throughout the day, as well as another move here in after hours. So what happens when you have that kind of uncertainty around a stock like SoFi? Well, you fall 3.6% in regular trading and down 0.75% here in after hours. Now, we have a lot to cover here in this video. Go over all of the uncertainties that you need to know and the specific data for SoFi stock. So the only thing that I will ask you to do is hit the like button and subscribe to the channel, because those things are free 99. And if you guys want to get yourself free stocks, links down below in the description. So let's get into this video. Let's first start off with the uncertainties that are happening today. So we could see ship departures from Russian ports fell by a third. Grain, coal shipments down 72%. So there's going to be more of that energy crisis concern. That's why oil was up over 5% today, especially for Brent. That was up a little bit more. It's come down here a little bit as the futures market is now open again. You can see up about 5%. So definitely a energy crisis kind of move you're seeing there. The grain problem. Russia-Ukraine accounts for 30% of all wheat products. So what's that going to do? That's going to add a lot of uncertainty to the potential food crisis. As well as that, even more so than the energy or food crisis, you've seen Jake Sullivan. He's basically, I believe he's the head of defense for the United States government. Could be wrong in that. Not quite sure. If you listen to what he said today that essentially Russia is planning an attack and didn't really specify on what, whether it was a chemical attack, a tactical nuke attack in Ukraine, or an attack on NATO. Did not specify that. But that's when the markets really started to wig out, if you'll call it. Started to panic. And if you look at the bonds, they also started to panic once he said that, because an attack, like we've heard that for almost a month now. You know, Ukraine, Russia, they've been fighting each other for a month. Who cares about an attack at this point as far as the stock market is concerned? Well, investors definitely started to panic. As well as that, you do have Biden going to Europe, going to Poland tomorrow. So that's adding a lot more credibility to what Jake Sullivan said. So it's very uncertain what that meant, what he was talking about. And that's a big fear catalyst for the market. So keep that in mind. Those are really the big uncertainties that did happen today, as well as some other minor things that are also going on. And I should point out that the UK just went into a technical recession today. So if that's a sign of what is to come for America, not good. You also have had Fed speakers over the past couple of days, and you had Bullard today, and he's more of a hawk on the economy. He's been saying we should have raised rates a long time ago. But he said that compare this to the early 90s when they raised rates 3% in 1 year. That's what they should be doing. Bring the federal funds rate up to about 2.5% to 3% and then go higher than that. That is basically the neutral rate of inflation. To bring it even higher than that, you're talking 4 to 5%. Markets did not like that. But the markets, they can handle rate hikes. And tech stocks, your higher growth sector, usually does decent during rate hike cycles. What is very uncertain is the balance sheet. And what Fed Bullard said during that, he said they have a lot of work to do on the balance sheet, that he would have supported just letting assets run off, but now they need to go more aggressively and they need to act a lot faster by letting the balance sheet run off, as well as to stabilize, he said, aka sell assets to get the balance sheet down. And if you guys are unaware of basically letting the balance sheet roll off, what that is, you'll be hearing a lot more of that. So let me give you the basically background to what that is. So when you roll off the balance sheet, imagine it like this. The Fed has been buying a lot of the short end of the curve. So you're talking the 3-month bond, 6-month, year, and 2-year bonds. They've been buying a lot of those. So it's made the balance sheet go up. The Fed, the government basically has to pay out that interest on those bonds, so it becomes a big liability. Now, what happens when they start to roll these assets off is instead of these bonds maturing and then the Fed having to pay out the full rate of the bond again to pay out the bondholder, right? Pretty simple stuff here. What happens when they roll it off is they pay out the bondholder, but they don't rebuy assets. That's why you can see a flat balance sheet, even though they're buying 3, 6, 12, 24-month bonds, is because once those bonds typically expire, they take that money and they just buy new bonds with it. So they keep the balance sheet pretty flat, and that has happened for a pretty long time, right? In between like 2014 and 2018, the Treasury, the Federal Reserve balance sheet stayed at about $4.5 trillion until, like I went over in a couple videos now, until end of 2018, 2019, they started to run off the balance sheet, and that's when the stock market had 2 crashes within a 20-month period. Back in 2018 and 2019, multiple crashes because of the balance sheet. So you really don't know what to expect when they're talking about running off the balance sheet and selling assets from their balance sheet. Last time it happened, and the only time it really happened, the markets crashed substantially, down 30% in a very short amount of time. So if you're talking about reducing the balance sheet by potentially 45-50%, that's going to cause a lot of uncertainty. So the more these Fed speakers come out and talk about the balance sheet, that's what is really going to drive the market one way or the other. And that's when the markets really started to sell off. Now, on the other hand, you are also seeing a run to safety in the Treasury bonds. And you could see, let's go ahead and take away the Bollinger Bands. You could see the Treasuries really started to go crazy, up 2.19% today, up 0.01% here in after hours. It was up even more than that, but we're seeing a big rally in the bonds. And the way to look at this is it's essentially like a dividend stock, a dividend payout, call it $1 per share, right? The share price is $100. That's a 1% payout per year. Well, if the stock goes to $50, now you get a 2% payout per year because the dividend yield stays the same. The price of that asset can fluctuate up and down, but the yield stays the same, or the fixed dividend amount. Now, what happens with Treasury bonds? It's the same exact way. So when the price of these Treasury bonds goes up, the yield goes down. So why would people basically buy a bond and make it go up and accept a smaller yield when inflation is this high, when there is growth concerns of growth slowing down and going into recession? Well, it's a flood to safety. And I think a lot of this had to do with Jake Sullivan's comments earlier, because that's roughly when the bond market started to make some really big moves. And usually you see this correlation where if bonds go up, stocks go down, because after all, they're rushing to safety. If they're going to buy bonds, they're also going to sell stocks. So this is a huge red flag. And if you pull this up and go to 2020, the crash, you can see exactly what I'm talking about. The higher bonds go, the more uncertainty and fear there is, the rush to safety there is. That's why the bonds went from 140 to 175 in about a 1-month time period because of COVID. But the bonds react first. Before you ever know something is actually wrong, you see weird moves in the bond market. Like a 2.26% day right here, February 28th. Down almost 1%, up 1.5%, down 1%, up 2.5%. And then you start to see the big moves once shit really hit the fan in 2020, up 5.20%. And then up another 2.72%, another 2.5%, so on and so forth. So the bonds react first. So there's something is not right that is going on behind the surface, because believe it or not, people with a lot of money, billionaires, your Bill Gates, your Elon Musk, your Jeff Bezos, your guys with a lot of money, especially with government ties, know what is going on. And the fact that the American government was right about Russia invading Ukraine, and now they're talking about a potential attack on NATO or on Ukraine as far as chemical weapons or tactical nuke, it's not a good sign. I'm not saying I know. I'm just relaying to you guys what happened today and really the fear factors that are at play right now. And that's really what affected SoFi stock as well. It was a bloody day in the markets, not just for SoFi, for a lot of other stocks as well. So that's what you guys need to know. As well as that, you do have some more data coming out tomorrow, like durable good orders. That's at 7:30 a.m. And then you do have initial jobless claims at 7:30 a.m. as well. And you do have Fed Waller that speaks at 8:10 a.m. Fed Evans that speaks at 8:50 a.m. And then Fed Bostic, he's more of a dove at 10 a.m. So a lot more Fed speakers, a couple data points that are coming out. So watch for those headline announcements. That's what is really going to move the markets. And as far as the projections for a possible 50 basis point rate hike at that May 4th meeting, it's now at 66.1% probability rate. So it's pricing in that we're going to get a 0.5% rate hike, only 33.9% probability that we do see a 0.25% rate hike. And over the past 7 trading days or so, this probability for a 0.5% rate hike went from 27% to 66.1%. So if you do see any dovish comments for whatever reason, that could also be another bullish catalyst, but it's not looking like that. Even the doves on the Fed board that are a part of the Fed board are even starting to talk a little bit more aggressively, a little bit on the bearish side or the hawkish side, if that's what you want to call it. Now, as far as the max pain, that is the maximum price that both parties, the buyers of calls or puts, lose the most amount of money. The option sellers make the most amount of money. The guys with all the moolah that want to push a stock to a certain price to make as much money as possible, market makers, hedge funds, institutions, think about those guys. That is at $9.50 per share by this Friday, whereas the price right now close to that at $9.31 per share. So it's not rocket science. Like I always say, it's not a definitive fact, but that's where they like to try to pin the stock, and that plays out time and time again. Now, as far as the actual data around SoFi and the technicals here, you can see we had about 38 million shares that traded hands today, and we're sitting right under $10 per share. We're not really falling all too much, definitely not down to these lows at $7.74 per share. The markets are becoming more comfortable with the Fed and those hawkish comments and their outline for 2022 and 2023, but the uncertainty around what Jake Sullivan said today, as well as the other key things, that's what could weigh on SoFi stock a lot more in the next coming days and weeks. So watch for that. See if we can break above $10 per share. We are really, really riding this Bollinger Band, this 20-day simple moving average. Take a look at this. 1, 2, 3, 4 days. We have not been able to get above that. Not even intraday most of the time. Hardly break above that, and then we'll come straight back down. That's at $9.76 per share. And I think it's pretty clear to see. This is why I like to pay attention to it, because it will tell you a story. And the story here is that hedge funds, institutions, market makers, they want to keep the stock under $10 per share, even though insiders are buying the stock, even though you're seeing upgrades to SoFi. You are seeing some downgrades as well, but the business is doing phenomenal. Yet people keep shorting the stock. Stock is likely to remain under $10 until some of these uncertainties go away and we get more clarity. Again, another big bullish catalyst will be once this Ukraine and Russia war does end. It will eventually happen. I can't tell you when it will happen. Eventually it will, and that's what is really going to drive us up much higher. The 50-day moving average is at $11.39 per share. For whatever reason, if we do rally above $10, that's the next level to be watching for. The MACD, you could see this yellow line is above the blue line, so that is bullish. The RSI is heading back down to that oversold territory. Neutral is at 50. We're at 43.59. So you're definitely heading down to that oversold side of things. So that's really it from the technicals. Volume has been lower over the past couple of trading days. Not really a big push to get above that 20-day simple moving average or the $10 share price. It looks like we are inevitably going to, but there might be more pain in the markets before everything is said and done. And some wild candles on the SPY. These are nutty candles. But nonetheless, let's get into the SoFi Ortex data. And you guys can see, again, if you did not know, insiders to the company are loading up on more stock. 18 transactions worth $2.36 million just over the past couple of days. Last trade date was March 17th. And the director, Schwartz, Harvey, Michael, I don't know if Michael Harvey Schwartz, I'm not sure exactly the order there. I believe it's Michael Harvey Schwartz. He bought about $500,000 worth of SoFi stock. So definitely good. Owns 214,000 shares of SoFi. Anthony Noto owns 3.06 million shares of SoFi as well. He has been upping his position a lot recently. All in all, $2.36 million at a time like this when almost no insiders are buying stock besides PayPal. I think it really shows a lot about where the business of SoFi is heading and how the next couple of quarters are likely to go. So that makes me want to buy more options on SoFi stock around the time of earnings. Now, as far as the short interest, you can see that's at 18.63%. Hedge funds, institutions, and market makers will not let up on their shorting activities, and that is very obvious. There is really no more sellers left in SoFi stock. As you can see, this yellow line has continued to climb higher and higher, and that is the short interest, whereas the price of the stock has continued to go lower and lower and lower. It is shorting activity that is pushing down SoFi stock so much, and obviously under its real fundamental valuation. We are looking at 134.25 million shares that are sold short. Cost to borrow max of 5.54%. Utilization of 100%. These numbers are fluctuating around a lot, so they're going to change on a day-to-day basis, but it's a good sign the longer the utilization stays at 100%, meaning hedge funds, institutions, they don't want to lend out their stock that they own, right? The long SoFi stock investors, they don't want to lend out their stock for 5.5%, which is not a half bad return. So that's definitely a good thing. Days to cover is sitting at 3.10, also showing you it'll be hard for shorts to get out of their short positions when indeed they need to or they want to. You are also seeing 10 institutional option orders today worth $2.95 million, positive order value of 76%. So considering we were down over 4%, including this move in after hours, to see a positive order value of 76% and $3 million, it's definitely a good thing rather than a bad thing. So that is pretty much going to do it for this video. That is all you guys need to know. Hit the like button and subscribe to the channel on your way out, because that is, after all, free 99. Get yourself those free stocks. Thank you guys for tuning in, and I will see you in the next one.